Well, greetings, Series 6 test takers. This is Dean Tenney, and I'm coming to you from my studio in fabulous Las Vegas. And we've been making a series of videos, started by accident, well, intentionally, but people were watching videos the night before or a day before morning of their exam, mostly in audio format during their commute, if they had like an hour commute. And I thought, well, maybe we should just make a 60-minute video that people could use as kind of a warm-up, kind of get their test taking chi on. So we made the first one, series 7 in 60 minutes, and it's had great feedback. A lot of people find it very helpful. We rolled out another for the SIE, and this is the third we're rolling out in this series. This is the series 6 in 60 minutes. Now, if you're not testing tomorrow or this afternoon, or then you shouldn't be watching this, right? This is not designed as a to learn new stuff the night before the exam. Just kind of get your rhythm established. So anyways, let's get started with some of the things. I would think of this as kind of just like an intellectual inventory as you go down to take your Series 6. And again, the key thing is if I bring up something and you don't know what it is, don't panic. Just, guess me on the exam and assign it to the universe. All right, let's start with talking about securities markets, investment securities, and economic factors. So as you should know, corporations capitalize themselves with two components: equity. There's no such thing as a corporation that has not issued common stock. And then they might decide to issue other things. They might decide to issue bonds or preferred stock or whatever the case may be. Now, in common stock, what you are is an owner of the business. You're an owner of the business, and you have a right to vote on matters pertaining to the corporation. The main thing that we'd be voting on, there's others like mergers or acquisitions, depending on what it is. But the main thing is we get to vote on the board of directors. And in the corporate charter, it will either be cumulative voting or statutory voting. Like statutory voting, if you have 500 shares, you have 500 votes. And if you are using cumulative voting and you have 500 shares and we're voting on 3 board seats, you would have 1,500 votes. And if we have cumulative voting, that protects the minority shareholders more, because on any one board seat or any one thing, they could have greater impact. Now, as an existing shareholder, you have a right to maintain your proportionate ownership in the corporation. It's called your preemptive right. And the way corporations do that is they make a rights offering to their existing owners. They say, we're selling more common stock. Would you like to buy the proportion necessary to maintain what is your current proportion ownership? And it makes sense that very important rights are short-term because the issuer, the corporation, needs the money and they need it now. And if they can raise it from their existing shareholders, they can pass on the savings to you. They won't have to hire an investment bank. So typically rights are short-term and they're exercisable below the current market price. Now, another type of potential equity securities, because when people exercise the rights or they exercise the warrants, what they're buying is common stock. So in warrants, corporations use warrants primarily as an incentive to get you to invest in another security, like a bond, for example. And warrants would be long-term, and they'd be exercisable above the current market price. Now, some companies pay dividends, some companies do not. If it's a corporation that pays a dividend, we would expect that to be more of a mature, stable business. And they would board get together and say, okay, let's declare a dividend, a distribution to our shareholders as of record. So that'd be a record date. And then, there's the declared date is when they had the meeting, declared it. And they say, you're a shareholder as of record. I'll just make one up, September 16th, you get the dividend. And then their payable date is when they actually write the check. That X date is the day before the record when we're talking about a secondary market. So the X date is the first date on which the stock no longer trades with a dividend attached. It's 1 business day prior to record. And then remember, just, don't be looking for tricks, but in an open-end fund, remember, you're doing business directly with the fund. That is not a secondary transaction. So in an open-end fund, all the dates, declared date, record date, X date, payable date, are set by the board of directors. In secondary trading, the X date is a function of the Uniform Practice Code, how we standardize practices within secondary trading of securities industry. And then it's very important to know in the code of conduct, selling dividends is a big no-no. That's anytime I'm using that artifice, the artificial sense of urgency to get you to buy the stock, because whether it's stock or fund, it should go down by the amount of the dividend. Another right you have as a shareholder is if we liquidate the business, the corporation, you have a residual claim. So theoretically, if we sold off all the assets, we paid off the liabilities, and there was money left over, you as a shareholder would be entitled to your pro rata share of that. A lot of times we refer to that theoretical value as the book value. So par value is an arbitrary number to set up the books. 1,000 for bonds, 100 for preferred stock, commons $1. I wouldn't worry about that. Market value is that supply-demand relationship, and book value represents that residual claim. Corporations may choose to issue preferred stock. The idea is these are things that mutual funds will own within their portfolios, perhaps. And in the preferred stock category, remember, it's called preferred stock because when you own preferred stock, you have preferential treatment in two areas. Dividends, the corporation cannot pay a dividend to common if it's arrears to the preferred stockholders. And you have preferential treatment in liquidation. So that's why it's called preferred stock. In the preferred stock category, we have cumulative, where if the corporation misses a payment, it goes into arrears. We have straight, where there is no it doesn't go into arrears. They miss it. They just try better next time. We have convertible preferreds and convertible bonds. Wouldn't worry too much about that on the Series 6, but this allows the preferred stockholder or the convertible bondholder, whatever the case may be, to convert their bond, switch their status from being a preferred stockholder or bondholder into owning the common stock. Those terms are set out based on par, and that's called the conversion price. So if we take par and we divide by the conversion price, we would find out, what the conversion ratio is. Now, if anybody ever asks you about economics, finance, or investments, you want to sound smart, you should say it has a lot to do with interest rates. And corporations want to be able to replace high-cost financing with lower-cost financing. So when interest rates come down, it's much more likely that the corporation is going to call away its preferred stock. It's going to call away and reissue preferred stock at a lower price, right? Same for bonds. So, preferred stock and bonds are typically callable. The call risk is associated with a declining interest rate environment. We have American depository receipts, foreign securities traded in domestic markets. You should know that. That's what that is. And then second thing is you have currency risk because the underlying business is conducted in the foreign currency. Well, then you have foreign currency. Now, I wouldn't worry too much about options, derivative investments on your Series 6. But, some mutual funds are allowed to use options within their strategies. Now, we have two types of contracts, calls and puts. You can either buy them or sell them. So we have 4 basic option positions. And some portfolio managers, mutual funds, are allowed to write covered calls, short or sell calls against the securities in the portfolio. And that would mean that bond might have a higher yield because of the income from selling the options than other, portfolios, all things being equal. Now, that would be, if they're going to be allowed to do covered calls, that has to be in the prospectus. Now, the disadvantage is they don't participate past the strike price. And again, some fund managers might buy calls, establish the choice to buy stock because maybe they're expecting to have some more contributions coming to the fund and they want to lock in that price. And then other funds are allowed to use options to hedge, where they can buy a put on the index that most closely approximates their portfolio if they're worried about systematic risk, or buy a put on an individual selection within the portfolio to hedge. So again, I think maybe one question, two, if you tell me you missed the mark on your 6 because of options, I would say, I think you had other problems. All right, so in terms of debt securities, we have 3 issuers, right? We have corporate issuers, we have municipal issuers, and we have the U.S. government are all issuers of debt-denominated securities. And in the corporate category, debt securities issued by corporations, we have secured bonds and we have unsecured bonds. Secured bonds have collateral, right? So we have mortgage bonds secured by real property. We have equipment trust certificates secured by marketable securities placed in escrow. We have equipment trust certificates secured by major movable equipment. And in the unsecured category, we have debentures and we have subordinated debentures. And one thing you need to be able to do is rank the securities we talked about earlier, liquidation, from senior to junior. So if a corporation liquidates, the most senior person in line to get money are the secured bondholders, then the unsecured bondholders, the preferred stockholders, and the common. That would be senior to junior. Junior to senior would be the opposite, right? Common, preferred, unsecured, secured. So I definitely know that. You should be prepared today or tomorrow to do current yield. What an investment pays you divided by market price, what it costs you. In a stock, that'd be annual dividend. A bond, it would be the annual interest. So if it's an 8% bond, for example, that's based on par, that's $80. You would divide that by the market price, and that would be the current yield. And most people would not be interested as a bond buyer in the current yield. They'd be more interested in what they make by holding the bond to maturity. So yield to maturity, if you buy the bond at a discount, is going to be the highest yield you could expect. And if you buy it at a premium, it's going to be the lowest yield you could expect. We have zero coupon bonds by all the issuers. Zero coupon bonds, zero coupon, no income stream. Sometimes referred to as original issue discount bonds. And you should know that zero coupon bonds are good for somebody who has a target date investment, somebody who needs like a set sum of money at some future date. You should know that as you hold the bond towards maturity, you have to do what's called straight line amortization upward, called accretion. And that imputed interest you're receiving is taxable. Sometimes we refer to that as FATM income, and you're paying taxes on that money you're not actually receiving. All right, so in terms of government securities, we have T-bills, which are issued at a discount. We have T-notes, 2 to 10 years. We have Treasury bonds that are greater than 10 years. We have government-sponsored enterprises. We have GNMA, we have Fannie Mae, we have Freddie Mac, where the fund manager might be buying proportion ownership in a pool of mortgages. You know, as many different types of securities as that's how many different types of mutual funds there are, right? And so if we are GNMA, unlike the others, pays interest and principal monthly, it's unlike the others, directly backed by the U.S. Treasury, and it's fully taxable. You know, Treasury securities are taxed. The U.S. government, U.S. Treasury can and will tax you, but not taxed on the state. Not true of government-sponsored enterprises like GNMA. They're fully taxable. All right, so municipal securities. There's 2 types of municipal securities. Those 2 types are general obligation bonds backed by the taxing authority of the municipality, and revenue bonds backed by user fees. You know, I'm kind of demented. Sometimes when I'm at an airport, I like to look for a sign. It says, sometimes I find it, and it says, your taxpayer dollars not at work. So you as a taxpayer are not financing a revenue bond, the user fees are. You know, if it's a school district or something like that, it's going to be financed through a GO. Now, in terms of suitability, remember, you're going to have muni bond funds, tax-free funds that own muni bonds. And so you need to be able to tell the customer whether you should buy a corporate taxable bond fund or a muni tax-free bond fund. And the way you're going to do that is by doing the taxable equivalent yield. If you don't know that, it's too late now, but you take the taxable yield times 100% minus the tax bracket, multiply. If we start with the taxable bond, we divide. If we start with the muni, it would be the tax-free divided by 100% minus the tax bracket. There is a type of revenue bond that is subject to the alternative minimum tax, and that is an industrial development revenue bond, an IDR, or sometimes referred to as an IDA. So if my customer is subject to the AMT, we want to make sure that we avoid funds that would be holding these bonds. Money market securities. Money market securities would be T-bills, nothing better than a T-bill. Money market instruments or securities are high-quality debt maturing in 12 months or less. But besides T-bills, there's also bankers' acceptances that are used to facilitate foreign trade, issued at a discount, max maturity 270, commercial paper, issued at a discount, max maturity 270, that's unsecured borrowing by corporations, negotiable jumbo CDs. And again, the reason this is on the test is we might offer as a parking spot for our customers' idle money, a money market fund, a money market mutual fund, right? So either a traditional bank account or a money market mutual fund. Economics, very basic. We have fiscal policy. Fiscal policy is government spending and taxation controlled by Congress and the president. We have monetary policy. That's the money supply. That's controlled by the Federal Reserve Board. And there are some interest rates you're held accountable for. As I mentioned earlier, you want to sound smart, somebody asks you about, you know, economics, finance, or investments, it has a lot to do with interest rates. You know, so one thing that the Federal Reserve Board does is tell banks how much they have to keep on reserve to meet their everyday demand for money, you know, banking. It's called the reserve requirement. And if I'm a bank with excess reserves, I can lend to a bank with deficient reserves. That's called Fed funds. Fund funds is the most volatile of all the interest rates. It is banks with excess reserves lend deficient reserves. Discount rate, that's from the Fed directly. So that's set by the Fed. That's the only interest rate set by the Fed. And remember, the Fed, the most common tool the Fed uses to control interest rates, their dual mandate is price stability and full employment, is the open market operations of the Fed. So the Fed buys and sells government securities. Now, too much money chasing too few goods is bad. That's inflation. And inflation is measured by the Consumer Price Index. So the Consumer Price Index is a price of assets, goods, and services in a particular city, and that's how we measure inflation. Two more interest rates you should know about is prime rate, banks to its best commercial customers, and broker call, which is used to finance margin accounts. That's banks to broker dealers. Currency rates. So, currencies have inverse relationships. So it's meaningless for me to say that the dollar is strong unless I tell you in relationship to what. Right now, the dollar is strong because interest rates in the U.S. are attracting more money. And when the dollar is strong, that means our dollars buy more foreign goods, right? So imports become more competitive and exports become less competitive. All right, well, if you want to start your own mutual fund, I don't know why you would. There are more mutual funds than there are Taco Bells. There are actually more mutual funds than there are securities put into them. But if you want to start your own mutual fund, you would have to comply with the Investment Company of 1940. Under the Investment Company Act of 1940, you would have to classify yourself as either a face amount certificate company. Now, again, if that comes up, it's going to be very low probability, but sometimes we refer to those as contractual plans. And contractual plans have a 9% max load. Sometimes these are used as a funding vehicle that's embedded into a variable life policy. But anyways, I wouldn't worry too much, but I know that 99%, I know there's a free look on that type of a transaction of 45 days. You can classify yourself as a unit investment trust, where we have passive management. The assets are professionally selected, but then there's passive management. The ones we care most about as test takers on Series 6 are open-end funds and closed-end funds. And you want to be able to contrast an open-end and a closed-end fund. Now, with your Series 6, you're getting what's called limited registration. And you're allowed to sell mutual funds with a prospectus in the primary market. And the major distinction between open-end and closed-end funds is open-end funds, as I mentioned, every share is a new share. In an open-end fund, they're continually offering new shares to the public. I mean, not only have to comply with, 33, they're also, 40, they're going to have to comply with 33. The closed-end fund does a one-time initial public offering, and then it trades supply and demand. Now, that's kind of interesting, right? I just had a one-time IPO, so there would be a prospectus. So the only time where you as a Series 6 can get somebody involved in a closed-end fund would be when it's offered in with a prospectus in the primary market when we're doing the IPO. All right, so a mutual fund under the Investment Company Act of 1940 has to have to begin operations at least $100,000 and 100 shareholders. And, if we want to borrow money, not to purchase securities, but to meet redemption requests, for every $3 in assets, we can borrow a dollar. The mutual fund has to have a clearly defined investment objective, because what we're trying to do is match the investment objective of the fund with, that of my potential customer. We have promotional expenses. Now, promotional expenses are not paid by the investor. An A share, for example, is a front-end load. And so this is a promotional expense paid by the fund. And 12B1 fees required to be implemented require a majority vote of the disinterested board. And remember, you have to have at least 40% of the board members of a fund that are disinterested, that are representing the public. So we're hoping that, if we're doing something we shouldn't, or it's not in the best interest of the shareholders, that at least those board of directors, that's called our outside board, those unaffiliated board members would say something. Okay, so we have to know who does what. So the typically largest expense to the mutual fund is the investment advisor fee. Remember, be careful, RTFQ. This afternoon or tomorrow, make sure you're reading the full question. If I ask, what is the single largest expense to a mutual fund shareholder, that's the load. I didn't ask that. The largest single expense to the mutual fund is the investment advisor who is making decisions buying and selling securities. We also have a custodian. Yep, the money and securities are still here. We have a transfer agent, be careful here, who redeems old shares and issues new shares, redemption, right? There's not this idea that there's somebody else taking your spot in the fund. No, no, no. We have to calculate the NAV at least once per business day. And the NAV plus the sales charge equals the public offering price. And the most that could be is 8.5%. And if we're charging somebody 8.5%, we've got to give them breakpoints and letter of intents and all that kind of stuff, which we'll talk about. The expense ratio is how much of the money gets eaten up with the people and folks we just talked about, right? So, you know, it's not the only comparison, but a fund with a lower expense ratio is leaner and meaner than perhaps another fund. So mutual fund share classes. We have Class A shares. Class A shares have that front end load, and it's, you know, kind of the traditional kind of thing. And a Class A would be appropriate for somebody who has a large sum of money and who's long term. We have Class B shares for people who may have lower amounts of money but are still long term. And the Class B share is going to have a contingent deferred sales charge. And that means, you know, if they stay in long enough, we'll waive that. But make sure on the test you don't misuse no load terminology, right? So I don't describe a Class B share as a no load fund. No, no. It has a contingent deferred sales charge. Class C shares would have a level load. And if we have a 12B1 fee, we can charge up to 1/4% and still refer to ourselves as a no load fund. If we go past a promotional expense, you know, marketing, advertising, paying people to sell the fund, if we go past that, we can't refer to ourselves as a no load fund. And over the life, we can't have more than 0.75%. So 12B1 fee, promotional expense, 1/4, 1%, 0.25, 25 bips or basis points. Still call yourself a no load fund over that. Can't refer to yourself as a no load fund. You can't go past 0.75 of 1%. Mutual fund redemption. So when you come into the fund and you get out of the fund, remember, we're always doing it based on the next calculation of the NAV. That's called forward pricing. So it's always based on the next, calculation of the NAV. Now, if you've been dollar cost averaging, dollar cost averaging is where you give me fixed dollars invested regularly. And the neat thing about dollar cost averaging is you'll be doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're high. That's exactly what you should be doing. And now you decide that what you want to do is redeem. And if you want to redeem, I say, well, listen, what shares do you want to do? Now, most of us would like, if we're not going to redeem all our shares, would probably want to redeem the shares that we have the highest cost base on, because that would generate the lowest tax. And that's called share identification. If we're liquidating all of them, we could do an average share. But important on the test, if we can't do share identification, we haven't done good records, and we're not doing average cost, then the IRS is going to impose upon us FIFO, first shares in are the first shares out. So if you're struggling with the tax question on your Series 6, always pick what yields the most for the U.S. Treasury. Now, mutual funds are managing public money, so they're not allowed to engage in, aggressive investment strategies like margin, like short sales, like naked options. Mutual funds, we're trying to match, remember, the investment objective with the customer. As I mentioned, there's many different types of investments we have. That's how many different types of funds we have. We have annuities. We have variable annuities. I think of a variable annuity as a mutual fund with an insurance wrapper. And in a variable annuity, you're using after-tax money. So that's going to represent your cost basis. So that's what you're putting in the variable annuity. And then that's going to grow tax deferred. And then when you're 59 and a half, you can choose to do a random withdrawal, lump sum, you can annuitize, you have a lot of choices. If you do a random withdrawal, it's going to be LIFO. Last money's in, first money's out. If you do a random withdrawal. If you do a lump sum, then what you owe taxes on is the difference between your cost basis, because remember, that was your after, tax money, and what you have now. And it's going to be taxed at ordinary income. Now, a nifty thing you can do is you can annuitize and turn the variable annuity, the lump sum, into an income stream that you can outlive. Now, you have some choices there. And the choice that will give you the largest monthly payment is life only. So life only gets you the largest monthly payment. I say, hey, when you get your check, give me a call, because your check is going to go up or down based on the assumed interest rate. We have an assumed interest rate. We won't be an insurance company long. We don't assume numbers that play out over the long term, the law of large numbers. But you call me, say, Donee, I got $4,000. I say, okay. Now remember, some of the $4,000 is your own money coming back to you. That's called the exclusion ratio. And your check is going to go up or down or remain the same based on the assumed interest rate, the Heir. So we get more than the Heir, the check goes up. We get less than the Heir, the check goes down. If we get the Heir, the check stays the same. Now be careful on your exam this afternoon or tomorrow that you don't fall prey to getting hung up on the numbers. It doesn't matter if the Heir is 4, it's 4.1 or 30%. As long as over 4, check goes up. Don't get hung up tomorrow. If I tell you the Heir and it's 4 and it's something less than, it doesn't matter how much less, it doesn't matter. The check goes down. By the way, when we do that, we turn the accumulation units into annuity units. And what I mean by that is you're in retirement. I'm not taking you from $4,000 to 1,000, 4,000, 4,020, 4,040, 4,020. It's not going to be bouncing in a big way. We have variable life insurance. Variable life insurance, remember, is kind of a hybrid where we have some money that is going into the separate account. The mutual fund. That's what that sub account or separate account is a mutual fund, right? So, a lot of times the questions are actually camouflaged mutual fund questions, right? So what I mean by that is, if I have 6,000 accumulation units in a variable annuity, intellectually, that's no different than saying I have 6,000, shares in a mutual fund, right? So that's kind of, what's going on. So, sometimes when you get an annuity question, just make sure you say, man, I wonder if they're trying to trick me and this is one of those camouflage questions. But some of the money, the idea of variable life is that at some point, maybe we have enough in the separate account to sustain the cost of insurance. And that's very testable. We don't ever sell life insurance as an investment. We sell life insurance as life insurance. And the death benefit will go up or down based on what's going on with the separate account, right? So it's calculated, the death benefit in variable life is calculated annually. The cash value is computed monthly, and it's based on the actual earnings, not the assumed interest rates. You can go from one policy to another. There's what's called a 1035 exchange. You can go annuity to annuity, life insurance to life insurance, but you can't go from annuity to life insurance. So you have life settlements. That's where you do a viatical and you sell that in the secondary market. And, I wouldn't worry too much about that sale of a life policy, but it's called a viatical. All right, so securities and tax regulations. We have 33. We talked about that. That's the Prospectus Act, primary market, and 34, which created the SEC. So sometimes you can get questions right by covering up the screen. Are they asking about, prospectuses? 33. People and places? 34. We have FINRA. So 34, by the way, the SEC has primary jurisdiction, interpretation, and enforcement of the domestic securities laws of the United States of America. And FINRA is the self-regulatory organization for the securities industry. We have the Federal Reserve Board, which is the regulator for banks, as well as the Federal Reserve Board, which establishes the rules about credit extension from broker-dealers to customers. That's called Reg T. And one thing Reg T says is ineligible, can't be purchased on margin, are new issues. And open-end funds are continually offering new shares. So can't buy an open-end fund on margin. 33, as I said, is the Prospectus Act. We're going to make our registration statement. And once we make a registration statement saying we're going to sell brand new securities to the public, we enter into what's called the cooling off period or quiet time, which is a minimum of 20 days. And what I can do during the cooling off period is I can send you a preliminary prospectus known as a red herring, which has pretty much everything you need to know except the price, which is important. I can, based on your indications of interest, key point, except indication of interest, I can't take sales. So I can give indications of interest. I can place a tombstone, and then where the effective date is when we actually have gone public. Now, whether it's a fund or not, or here it's a stock, and we're doing this, we're supposed to be doing due diligence, making sure that all the information we're offering to investors is truthful and relevant, not false and misleading. You're going to have an underwriter, right? An underwriter who helps you through the process as an issuer. And, the underwriter is going to sign up people as members of the selling group. By the way, this is very much how the mutual fund's done, right? So you, as a Series 6, have what's called an approved product list. The approved product list is the funds that you can sell. You as a baby broker, you might want to say, yeah, where's our approved product list? And who knows, maybe it's Franklin funds, American funds. Those are all the funds you can get people involved in. You have a selling agreement. What you are is a member of Franklin Templeton Fund Distributors, FINRA member firm, their selling group, and you go out and try and sell the fund. Now, remember, you can't give concessions, discounts, allowances to, people who aren't registered. But some funds will allow you as a Series 6 to buy the NAV, and that's fine. The main thing for us as it relates to this relationship of the fund distributor, which is a FINRA firm, the underwriter, sponsor, distributor, is the maximum gift or gratuity that an associated person of a FINRA member firm, the fund distributor, can give to the association person of another broker dealer, your firm, in the selling group. I'm assuming you're not working, that you're watching this, you're not an inside wholesaler, Franklin or American funds, but I'm assuming most of you are going to be selling, mutual funds to retail customers. That's what the test assumes anyways. Remember, that's $100. I would have never made it in my career without the help of my wholesaler. He said, Dean, why don't you invite your prospects and clients to a seminar this evening? I'll come talk to them about professional management, diversification, ease of ownership. I'll pay for the pizzas and the sodas, not a problem. So this rule doesn't apply to normal deductible business activities. And this rule does not apply to reminder advertising, tchotchkes. I had an umbrella one time, and it was beautiful. I said, where'd I get that? My host said, Dean, do you see the name on it? I'm the one who gave it to you. So embarrassing. All right, so 34 says you're going to have supervision of associated persons. So your supervisor, if you're supervising sixes, you're either going to have a 24 or 26. 26 only allows you to supervise people selling mutual funds with a prospectus. 24 is a general securities principle. Who knows, and maybe I will see you in one of those classes. So we said people and places, two market centers, the two major market centers in the secondary market are the New York Stock Exchange and NASDAQ. And I would know that the New York Stock Exchange is an auction order driven market. That's what they're doing, matching buyers and sellers. And I would know NASDAQ is an over-the-counter market. There's others, but that's the major one. And over-the-counter markets are best characterized as negotiated quote-driven markets. We also have the third market, which is listed securities traded over the counter. We have fourth market, which is direct trading between institutions. And the over-the-counter market, we have what are called dealers or market makers who post their quote, their bid and their ask, the price at which they're willing to buy the security into their inventory and the price at which they're willing to sell it out of their inventory, the bid and the ask. So the customer, when he's looking at two prices, he's going to pay the high price, the asking price, and the customer is going to receive the low price, the bid price. That's called the spread. When do trades in the secondary market settle? Regular way settlement, Uniform Practice Code of FINRA, is T+2. So trade date is when we agree to terms. The second business day is when ownership changes hands. Now, we don't tell customers this because we don't want to use our money to settle their trades. But the Federal Reserve Board says customers actually get 2 additional days to pay for their transactions in the secondary market. So they basically get T+2+2. They actually get, 4 days. That's for corporates and munis. Taxation. I wouldn't worry about the, your income tax, except that, remember, it would be important to know your tax bracket in terms of figuring out whether you should be in a taxable bond fund or a tax-free bond fund. Capital gains distributions is when we sell securities. Now, whether the fund sells the security, the fund manager, or you sell the security, you have individual investments, to qualify for a long-term capital gain, you have to be at risk for more than 12 months. And if you're not at risk for more than 12 months, then it's going to be a short-term capital gain. And the idea is that short-term capital gains are going to be taxed at your ordinary income tax rate, whereas long-term capital gains qualify for a lower rate. So it's a little more tax efficient if it's longer term. Now, I can take losses from my investments against my earned income, me working for money. So I'm retired out here in Las Vegas. I was a broker for many years. And, now I make some ice cream money, tutoring and teaching and doing things like that. And let's say that me working for money is $50,000. And in my portfolio this year, when I net all my gains and losses, I have lost $20,000. Well, all I can do is take my income down to 47. So you could take $3,000 against that earned income. Cost base of shares transferred. Be careful here. So there's two scenarios on the test. One is Dean is a living, breathing human being walking planet Earth, and I gift my stock to my nephew. So I buy 1,000 shares of Apple today at $153,000, and I'm still alive, and I gift that to my nephew. He assumes my cost base, which is $153 a share. Now, if I die and I gift it to, don't gift it to him, but it's a part of my transfer to him, and he's an heir, and so I'm dead. That's going to be different. There's going to be a step up in the basis. So let's say Apple's 200 when I die. So now his cost base is 200. So two scenarios there. I'd have a general understanding of retirement plans. Big time, I kind of know the big numbers, 59 halves when you choose to draw down. If you would draw down early, you're going to have a 10% penalty. I would know if you do a rollover, you have 60 days to get it back in the same spot. I would know you have to do required minimum distributions at 72 unless it's a Roth. So a Roth, you can have tax-free withdrawals and there's no RMD of your original contributions. You're not using pre-tax minus point. I'd be able to contrast a Coverdell with a 529. I know that a 529 is a better deal on the test anyways, right? Because it's not means tested. You can put a lot more money in it, so it comes up the winner. Instead of 2,000, you can front load with 5 years and not pay the gift tax. Remember in the 529 category, we also have prepaid plans where, again, the question here would be, I just buy the bachelor's degree, and by doing so, it's a good inflation hedge. I'd have a general understanding of ERISA, the Employee Retirement Income Security Act. I would know about TSAs, tax sheltered annuities, TSAs. And the test question here would be to make sure you know who qualifies for a TSA. It would be employees of educational establishments, 403B, or employees of educational institutions, or employees of 501c charitable organizations. I would know the difference between a defined benefit plan, where the employer assumes the investment risk, and a defined contribution plan, where the employee assumes the investment risk. The one most people are familiar with is a 401k. I would have a general understanding of the Investment Advisor Act of 1940. If I'm going to give investment advice, and I tell people I'm in the business of giving investment advice and I want compensation, I'm going to have to be an investment advisor. Now, some of you, after you pass your 6, may be taking a 63 and a 65. And the reason you're taking the 65 is to be an investment advisor rep and be affiliated with, being able to make fees as well as transaction commissions. So right now, the way it works, if you're just getting a 663, is, I say, listen, you ought to buy a mutual fund. You say, Dean, what do I owe for that advice? Nothing. You say, well, where I can get a mutual fund? I say, yeah, from me, right? I have a 6 and I can get you involved. So I would have general understanding of that. SIPC, I would have a general understanding. By the way, I don't have to be an investment advisor if I'm giving you advice and it's free and I'm being paid on transactions. Anyway, SIPC, I would know the max coverage is $500,000, which no more than 250 can be cash per separate customer. Every account that has different beneficial ownership. I would be aware of the Insider Trading Act of 1988. I would know that it's triple damages. So if I make 9 million, I owe 27 million. I would know that it's also not only civil, it's criminal. The criminal penalty is up to 20 years. I would know Regulation SP, that we have an obligation as a financial institution to protect the privacy of our customers. And if we want to use the information to cross-solicit the customer, we need to have their permission. All right, so marketing, prospecting, communications. So there are 3 buckets of communications on your exam. Institutional communications, which I wouldn't worry about at all as a Series 6 test taker. Retail communications, which I would. Retail communications are for more than 25 persons in a 30-day period. So 25 retail persons, more than 25 retail persons. Now, the test question, if it's more than 25 and it's retail communication, it has to be approved pre-distribution by the principal. If it's correspondence, so that's our third bucket, right? Institutional, who cares? When I say who cares, I mean for test purposes. Retail communication, more than 25, approval, pre-distribution. Correspondence, 25 or fewer, and there the principal can approve it pre or post-distribution. It's the customer, the principal's choice about how to go about that. We file retail communications with FINRA. If we're a first-year firm, we file it 10 days prior to first use. If we're an established firm, we file it 10 days after first use. When selling mutual funds, particularly as we said A shares, we have breakpoints. Be careful, again, RTFQ, read the full question. Breakpoints are good. A breakpoint is a quantity discount. It's a good thing. A breakpoint sale is a bad thing. That's when we try and maximize our commission by avoiding the breakpoint. So be careful, right? Breakpoints are good. Breakpoint sales are bad. So, you say, Dean, it's unfortunate, but for my initial investment, I don't have enough to qualify for the reduced sales charge. The easy way to stay out of trouble here is to tell everybody how to get the best deal. I said, well, why don't we fill out a letter of intent? The letter of intent is good for 13 months. And there's no way you can be hurt filling out the letter of intent. So unilateral contract, it's only binding on the mutual fund, not binding on the customer. So you get your 6, you're properly registered, you're effective, you have a nice ticket, and let's say the breakpoint is 100,000 or more. And I'm looking at your application as your supervisor. Wow, good job, $80,000. Did you tell them about the breakpoint? You go, oh man, I got so excited, I forgot. Good news, the letter of intent can be backdated 90 days. It can be backdated 90 days. Now, rights of accumulation are different, right? So customer says, Dean, there's no way I'm coming up with the money. I said, well, let's at least get you rights of accumulation. With rights of accumulation, there's no time limit, but you don't get the reduced sales charge up front. You get it when you cross. When you cross the breakpoint on that and all subsequent investments, you get the reduced sales charge. Investment clubs cannot pool their purchases for meeting the breakpoint. So no breakpoints for investment clubs. And we said the maximum charge is 8.5%. Okay, so types of accounts that we have. How do we register the account? We have individual accounts. That's pretty straightforward. We have transfer on death, which allows transfer on death to transfer the assets without probate. So transfer on death allows the account to be transferred and avoid probate. We have joint accounts, very testable. Customer accounts is testable. So I know some of you already took your SIE, and so there's some overlap here, but remember, you got to be able to contrast joint tenants with rights or survivorship with tenants in common. So with joint tenants with rights or survivorship, both parties own the account. There's no fractional interest. And the decedent share goes to their estate. With tenants in common, there is a fractional interest, 50-50, 80-20, whatever the case may be. And the decedent share goes to their estate or beneficiary. So again, very testable. We have Uniform Gift to Minors Act, and we have Uniform Transfer to Minors Act. And again, we should be able to know about this. It is testable. This is high probability. So 1 minor, 1 custodian per account, no margin. The kid's tax ID number goes on the account. The distinction with Uniform Gift to Minors Act, we re-register at age of majority 18-21, depending on the state. With Uniform Transfer to Minors Act, we re-register, we can stipulate up to the age of 25. Corporate accounts, we need a copy of a corporate resolution saying which corporate officer can trade the account. I'm joking, right? If we need a copy of the corporate charter, if they want to see what's specifically permitted. I don't think it'll be a big deal selling mutual funds, but right. If it's a partnership account, we need a partnership resolution and perhaps, again, the partnership agreement to make sure whatever they're doing is acceptable based on either corporate charter, if it's a corporation, or partnership agreement if it's a partnership. Discretionary account, what constitutes taking discretion? If I, as a rep, am making a decision about action, whether to buy or sell, asset, which security to buy or sell, amount, the quantity, I need to have discretionary authority on your account. I do not need discretionary authority on your account to make a decision about time and price. So, if I say, liquidate $10,000 of the Acme fund, liquidate 10,000 of the Acme, the 3 A's are present. Do it at whatever time and price you think's right. But if I say, hey, I know I have more than one mutual fund, sell whatever one you think I should redeem. And that's unacceptable. That's unacceptable. Now, if we have powers of attorney or trading authorization, we have two. We have limited trading authorization, limited power of attorney, where all I can do is make decisions about investments, and I have full trading authorization, where I can only make decisions about investment transactions. I can withdraw monies and securities. That would be a bigger supervisory challenge. We talked about, hinted about some violations of the Code of Conduct. The Code of Conduct is the ethical behavior that associated persons of broker-dealers and broker-dealers owe customers. And under the Code of Conduct, we said, no selling dividends, no breakpoint sales. These are known as the conduct rules, You can receive continuing commissions from a rep who is retired as long as there's a written contract, right? So continuing commissions with a written contract. For somebody who was registered and is no longer registered, you need to get prior written notification or give prior written notification to your firm for outside business activities. If you're going to get people involved in investments not sponsored by your broker-dealer, again, you need to make written notice, because if you don't make written notice and they determine where there's an adverse interest, that's called test question selling away. So if they say on the exam, an associated person sells an investment not sponsored by their employer without notification, amounts to permission, without permission, this is a prohibited practice and is known as, and you would say, selling away. If you're opening an account in another firm, firm A is going to make written notice to firm B saying you're attempting to open an account. We talked about gifts already, selling concessions we talked about. So we didn't talk about churning. Churning, our trades are excessive in size and frequency. We didn't talk about front running, that's trading ahead of customers. These are all prohibited practices. We didn't talk about opening fictitious accounts to win the new account contest. Absolutely not. So we talked about that. So Code of Conduct, there's also what's called the COP, the Code of Procedure. So the Code of Procedure is when you hear from FINRA's Department of Enforcement. So FINRA Department of Enforcement contacts you, you respond within 45 days. And the Department of Enforcement can fine you, censure you, expel you, bar you. Stupid but testable. They don't have a badge and a gun. So, they can't throw you in jail. Now, if you think the Department of Enforcement of FINRA under the Code of Procedure has been unfair, you can appeal that to the National Judiciary Council. I wouldn't be surprised when they uphold the locals, because that's typically what they do. And then if you still think you're getting not a fair deal, you can go to the SEC, and they typically are going to uphold FINRA. Then you can go to the court, all the way to the Supreme Court if you'd like, right? Now, sometimes FINRA, the Department of Enforcement, will ask you whether you want to admit guilt to a minor offense. And if you'll accept the fact set, waive your right of appeal and consent for a minor rule violation, $2,500 might not be a bad idea, right? $2,500 and everybody gets on with their life. Now, you can also make your own offer as a respondent. You can say, hey, I'd like to make good, here's what my offer is. If you're going to do that, by the way, it should, should see what other people did, what you did, and what they paid, and be in that general kind of same monetary area. We also have the Code of Arbitration. The Code of Arbitration can be between the firm and the customer. The customer has to agree to the process. Now, if the customer doesn't agree to the process, we're not going to open the account. But on the test, make sure you understand the customer has to agree to the arbitration process. Some states require mediation, and if they do, we do mediation before we do, arbitration. We have simplified arbitration for $50,000 or less. And in simplified arbitration, we have one arbitrator, which means it's easier to figure out what's going on. And so we don't need to have a hearing. And we don't have arbitration for our employees. You as an employee, an associate person, agree to go arbitration. It's in your U4. The exception would be for HR issues like sexual harassment, things like that. All the decisions in arbitration are final and binding. There are no appeals. So remember, you can appeal a code of procedure thing, COP. We think there's COP, do bad things, COP shows up. Not so of the code of arbitration. All right, so the awards must be paid in 30 days, and the statute of limitation for arbitration is 6 years. We have the Patriot Act, and the Patriot Act is to combat money laundering. So every firm in its WSPs, its written supervisory procedures, has to have a section about how they're going to combat or, do anti-money laundering. So under the Patriot Act, we're going to have a picture ID to open the account, so we know that you are who you claim to be. And the Bank Secrecy Act allows us to file information with FinCEN for currency transactions, receipts. The CTR is for transactions in excess of $10,000. We also file suspicious activity reports for transactions that are commercially illogical. That's like red flags, like, where what they're doing makes no economic sense, the origin of the funds, whatever the case may be. And that is for $5,000 or more. We talked about picture ID. And we also have what's called the OFAC, Office of Foreign Asset Control, to make sure we're not doing business with anybody who's on, a list that we're not supposed to do. Like right now, some of the Russian billionaires close to Putin, for example. Anyways, suitability and risk. We need to, when we are trying to figure out, for us to do a good job for over time, we need to know a lot about the customer. And so when we open the account, we're going to do some data gathering. And we want to know your name, your address. We need your physical address. Now, we will send things to a P.O. box after we open the account. But on the physical original hard card, we want to have a physical address. We need your tax ID number, your social security number. We talked about a photo ID. We're not supposed to open accounts for minors directly. And the easiest way to make sure you're not a minor is to ask you your date of birth. Occupation. Remember, if you or your spouse are associated with a FINRA member firm, I'm making written notice to your firm, and I'm going to follow any special instructions they give me. Accounts are accepted by a principal. So you say, I have an account. I say, no, you don't, not until I approve it. Have you done any trade yet? You better say no, right? It's very important, this information. So we tell the customer that, listen, we want to make sure we dotted every I, we crossed every T. So within 30 days, I'm going to send you a copy of the new account form. Could you please look it over and make sure everything's okay? If not, please, let us know so we can make the correction. We realize that over time, your investment situation could change. And so we're also going to do that every 36 months just to make sure, there's been no material change in the information we're holding on your behalf. Anytime somebody messes with the account, changes something, that'll kick out a copy to you within 30 days. So one thing we want to do in terms of a customer profile is say, hey, listen, why don't I start our relationship here by doing a balance sheet for you? Let me just see where you're at, what your net worth is as of today, right? And could you tell me about your current assets? Cash or things you plan to turn to cash for 12 months or less. Can you tell me about your long-term assets? Your house, your car. Let's go over your current liabilities, things you're going to pay 12 months or less. Let's go over your long-term liabilities, mortgage on the house, for example, car loan. And let's establish what is your net worth. What is your net worth? And then we can revisit this. You want to revisit this, every quarter, every year, semi-annually. And what I'm hoping is we'll help you be able to, get that number to work in our favor and go up, right? We need to know about your investment experience. We need to know about your investment objective. Are you investing for growth? Are you investing for income, growth and income, total return? How liquid do you need your investments to be? What is your attitude towards risk and reward? So that's really kind of important in that first step in terms of suitability and risk. And certainly, more often than not, we're going to test you what would clearly be unsuitable given somebody's investment objectives. Types of risk. So, types of risk we have credit risk. Credit risk is associated with debt-denominated securities and that the issuer doesn't pay the interest and principal. And that's one reason, to own a bond fund. It's unlikely that every bond on the portfolio is going to default, but, That's what credit risk is. There is a tendency of securities prices to move together. That's known as systematic risk. And remember, non-systematic risk is also known as selection risk. There were 10 equally suitable ideas. I picked one of the 10. The other 9 did fine. The one I picked went under. And the easy way to do that is to diversify. And the easy way to do that is in a mutual fund. But remember, risk prevails in a mutual fund despite your diversification. So you're still exposed. You're not exposed to selection risk in a mutual fund, but you're certainly exposed to a systematic risk. A purchasing power risk, right? Inflation, and we might want to own common stocks or a common stock mutual fund and not, bonds. We have legislative risk. Congress changes the rules. For example, the dividend exclusion ratio used to be 70%. Now it's 50%. So we have legislative risk. We have call risk. We talked about that, declining interest rate environment. And remember, if you're in a bond fund and interest rates go up, the NAV is going down. Returns, we said you can, your returns, you're only going to make money one of two ways in an investment, either the income stream and or price appreciation. So if there's no income stream, it's going to be price appreciation. And we said if it's price appreciation, watching the NAV of your fund go up or watching your investment go up, that's not taxable. But when the fund manager sells, then that's going to be a capital gains distribution, and that is going to be testable. And it'll either be short-term or long-term based on how long the fund has owned the investment. Let's see. Okay, I think that's pretty close to our Series 6 and 60 minutes. Let me know. You're probably going to do next your 63. And I would imagine after that, you're going to be doing your 65. Remember, I guess I can't discipline you if you've already got to this point and you're not testing tomorrow or this afternoon. But that being said, when you do watch this, if that's the next leg of your journey, let me know if you found this productive or not, because I may skip if people don't find it as useful. I won't do a 63 in 60 minutes. I'll skip. All right. So remember, inch by inch, your Series 6 is a cinch, yard by yard. Your Series 6 is hard.